Good morning, ladies and gentlemen. A warm welcome also from my side. Thanks very much for joining us for the Capital Markets Day 2019 here in Vienna. Following up on the presentations of Andreas Streichel and Bernhard Spalt, I will now step into the following topics in more detail. First, giving a little bit of an summarizing overview of our profitability outlook, then having a closer look at net interest income, fee and commission income, and obviously also the cost side. Then I will turn to capital and first time also give a little bit more detailed information on the MREL execution that we are planning, and this all should then arrive into the overall conclusion and outlook for 2020. So I will start this with this kind of heat map here, and just in order to avoid any misunderstandings, a green plus means a positive impact of the respective position on a year-on-year basis, so 19 to 20 when it's the column of 20, and in the year 19 versus 2018 when it's in the column of 19, and of course the minus respectively negative. The equal signs show that there is no material change on a year-on-year basis. We will deliver NII growth in 2020 again. This NII growth is very likely going to be slower than in the last 2 years, for the simple reason that we expect slightly moderating loan growth, and of course the interest rate environment, as we will discuss in a second, and a closer look on NII is not really helping in that matter either. On fee growth you will hear much more in the upcoming sessions. Still, it's important to mention here that we will have a positive momentum here in the next years. Also in 2020, this is not so clear because in 2020 we will be hit by the incoming SEPA regulation that you are well aware of. We've done our calculations there, and the impact of this is around about 20 to 25 million euros. Despite this impact, we will clearly grow our net fee and commission income substantially also in 2020, and we have already heard about the longer-term outlook up to 2024. Where we are a little bit cautious is the trading/fair value result, for the simple reason that 2019 has been so far, and there are no signs that this might change till the year end, has been, I would even say, excellent. Still, this minus here doesn't mean that I expect any substantial deterioration. It's simply the probability that we will not be better than 2019 is high enough that I'm a little bit cautious on this position. Costs, I give you two numbers in that respect, practically saying the same. We want to limit our cost updrift, which is basically driven by wage inflation in many of our countries, combined with the necessary and very important IT investments. We want to limit it to less than 100 million. In other words, round about 2.5%. And I will go into more detail anyway then on the deep dive. Risk costs have been commented upon already, and in the next slot you will get much more color on the overall risk outlook as we see it. Overall, from my perspective, from the finance side, we can clearly comment that asset quality, also in the growth scenario that we are currently still and very positively in, is holding up strong. When it comes to other operating result, we have booked in the second quarter of this year the impact of the decision of the Romanian High Court. If the Slovak banking tax is actually enacted, then our goodwill on Slovenská spořitelna in the amount of 165 million might be at risk in an impairment test. However, independent from that, this will not have an impact on the dividend for 2019, and also we are confident that our ROTE guidance for 2019 will be delivered. So with that, let's jump to the net interest income. I think many of you have heard from us in the last few quarters this kind of headline, NII beats NIM, which doesn't tell anything else than the loan growth, so to say, not only mitigates but outperforms on a net basis the compression in margins. You have here on the right hand side a kind of indication in which countries the pressure was the biggest. Obviously you see the biggest pressure in the years since 2015 happened in Slovakia. Not a big surprise, because this is a combination of Euro country and of course very dynamic development of the market, like in a CE country. In the other countries you didn't have this full combination, and actually Austria has been holding up quite well, even though we have been growing our market share and our overall loan book quite substantially there as well. Maybe just one word with regards to our loan growth, and the colleagues will anyway discuss in more detail how we want to grow the respective businesses. What I think is very important, a 5% loan growth will have to be a combination of growing with the market in those areas where we feel already comfortable with our current market share in those sectors, and outgrowing the market, in other words, gaining clients, gain market shares in our focus areas as they've been selected both in the risk appetite strategy and in our business focus. Very important to mention, obviously, when it comes to NII is also our back book. Those of you who know us for longer, that's the vast majority, know that we have been always indicating 40 to 50 million impact on our investment book. Now, why has this been turning out so much better in 2019? I can proudly say that the colleagues have had a perfect timing with regards to the investment. For example, in Czech Republic, we were executing 80, 90, 85% of the whole investment plan very early in the year, which was, of course, an excellent timing. This cannot be granted for forever, of course. We hope that we will have a good hand again next year. However, this indication of round about 50 million euros drop is simply ceteris paribus, meaning if we have an average of the levels that we have had in 19 versus the levels where we are today, this is a good indication, or rather, from my perspective, a bad indication, how much less we will generate from that. And I mean, what we always have to also mention in that context, the positive flip side of the coin is, and you know all our transactions in the bond market, that we have been funding on excellent levels throughout all the asset classes, in all the transactions that we have been delivering this year. We have been delivering the leading transaction in our peer group. One element that has also always been requested by many colleagues in the room is giving an indication of on our NII sensitivity. Now, you all know it's a very tricky thing to throw a number, but we did the exercise to really do a parallel shift of 1% across the curves, and the only particular feature we had to incorporate into that chart is, of course, to make to distinguish between full or no deposit repricing. And obviously you see this makes a big difference. Not a surprise, we all know how it happened in the last 2 years in Czech Republic. Overall, one can say that we are obviously biased to the upside on the interest rate environment. Now, one can say, following what Mr. Treichel said, that is maybe not the smartest position. On the other hand, in Euroland, to be honest, going too much lower, especially across the curve, is very unlikely. This is the picture, that's how we are positioned, and this is the best possible indication we can give. One word on ALM. I think it was a very good decision 2 years ago put much of a focus, especially in Austria, on fixed rate loans. You know that the Austrian market has been a floating rate loan market for a long time. This was a very good decision on both on ALM perspective as well as from the difficulties from a legal perspective when it comes to negative rates. I'll be relatively short here on net fee and commission income because we spend a lot of time during the day on this extremely important matter. Just also from my personal perspective, I've been working in the markets area for a long time, and I'm totally convinced that the asset management strategy is not only very important for the whole region, it is going to be delivering us a significant upturn in fee income if we get it right. This is a long-term story because we are a bank which is dealing with its customers in a responsible way and leading people in a one-shot exercise into the markets, especially at that point where we are today, would not only be unfair and maybe not the right strategy, it would also be not long-lasting. We are convinced that combined with a digital offering in a long-term asset management strategy, we will succeed and we will extend our leading position there. Bank assurance, equally important. We are teaming up very closely there with our partner VIG. We are matching pretty well across the region. What we have to extend there, obviously, is to become broader in the product offering. Historically speaking, we were always quite strong in life insurance. We all know life insurance maybe not the best product in times like that. So we definitely have to increase our penetration there into other product fields. Costs. Yes, we are addressing the Austrian cost challenge. We have been doing reasonably well in the last few years in terms of starting to contain the costs in Austria. We have not been successful yet to turn the momentum around. There are various reasons for that. I will not use the excuse of the savings banks, because we can clearly distinguish between costs that are coming from the savings banks and those which are, so to say, self-initiated within the Erste entities. I think you will also be able to follow the path of our achievements there. I guess we are on a very solid way to plan and to implement that and doing it step by step in order to contribute positively from the Austrian side. In the other countries, it will depend very much, of course, on the dynamics of wage inflation. You see some numbers here. In some of the countries, we were just able to negotiate very well within our banks because the average wage inflation in some of the countries was even higher, in some cases even double digit. So this offers, of course, on the one hand, a big challenge on costs. But obviously, these people who are making more money now there and earn more are also, to a very large extent, our customers. One sentence with regards to IT costs. We're talking about around about 25–26% of the overall costs across Erste Group. And I think what will be extremely important there, together with my colleagues on the IT side, who you will hear, is that we clearly understand what we are spending our money for. I think it has been mentioned already that regulatory coverage of regulatory needs is a must. However, the percentage of that needs to be kept under control so that we have enough firepower to invest into our digital platform, George, and to really push forward our progressive IT modernization. And I strongly believe that medium term, obviously IT should indirectly and directly contribute to our cost containment exercise. Capital, fairly easy with regards to numbers. The only small change, obviously in times like that, to the upside is that we will have a core equity tier 1 requirement of 12.36% in 2020. The upside, this increase comes, as you see from the chart, from the small increase of counter-cyclical buffer. That allows us to stick one-to-one to our internal core equity tier 1 capital target of 13.5 and maintain the 100 to 150 basis point management buffer in all our communication. Now, what do we define as excess capital? You've heard that quite often already from management. I just need to repeat it once more. Should we, given the current regulatory requirements, should we have a sustainable level above 14%? This would trigger, from our point of view, the necessity to either distribute something like a special dividend or consider a buyback of shares. Clearly, we will be easily achieving our capital target by the end of the year, but we will clearly not be in this area of excess capital either. One sentence regarding M&A. We've always said, and we stick to that, it's not an active agenda point. We are convinced that we have so many things not only to do, but also to deliver out of our existing franchise, that the M&A will never be closed, but it's not the one which we are pushing forward heavily. mBank is on the table. It came on the table, to be honest, from my personal point of view, quite surprisingly, but that's a different topic. Latest info is that next week, I guess, the info memos will be out. We will look at that and we'll keep you, of course, posted with regards to any further considerations in this potential deal. Last but not least, because this has been discussed with Thomas Sommerau and his team in the recent weeks, I can assure you that we will do everything in our power to avoid any unjustified double counting in the area of systemic risk buffer and other systemic institution buffers, because we simply regard that as totally unjustified. However, this discussion with the regulator is ongoing. We are quite optimistic, but I think it's fair and correct to mention that this is still somehow in the air from one or the other, let me say, creative regulator. MREL. I'm really happy that after so many meetings where we had to say, you will see in the first quarter, you will see at the Capital Markets Day today, we can say a little bit more about MREL. What has not changed is that the final decision is still expected for the first quarter. However, we have done a lot of work already. It's a very complicated matter in the detail. For those not so familiar with the matter, we have been opting for, or we want to target a multiple point of entry resolution strategy with 6 resolution groups: Austria, Czech Republic, Slovak Republic, Romania, Hungary, and Croatia. There is one resolution authority, and you all know it's Romania, which is, I will be precise here, in this process with ECB, mediation process it's called. We hope that this mediation process will lead to a positive outcome. We, of course, cannot promise that and not influence. Other than that, we are clear with the respective local authorities. On the right-hand chart, you see our current best possible estimation on the issuance plan. What is very important to say, all the planning for issuance locally as well as on the group level is fully incorporated in our budget. We see also, I personally also see a small little positive in this whole exercise, meaning that we can develop one or the other local capital market, or at least this could be a feature to help to develop that a little bit. Other than that, it's connected to costs, but to costs that we regard as not really so material. For next year, it's something, we wrote down 13 here. I say 10 to 15 because no one really exactly knows at what levels we will be executing, but definitely not more. And in the long run, it should be around about 60 million euros out of the overall coverage of our MREL shortage. All of that brings me to the following, as I believe in this environment and compared to a lot of competitors, constructive and positive outlook. First, we are very convinced that the macro environment will remain positive, while maybe a little bit moderating from the last years. And definitely our countries should be outperforming Western Europe again in the upcoming years and confirm the convergence story. Loan growth, we expect in this environment to be in the mid-single-digit area. And as it has been already mentioned by Bernd Spalt, I completely can confirm that it's the clear ambition to deliver positive jaws. But in all fairness, I have to say that I'm not in the position to set it as a guidance or a hard target. We'll keep you posted, of course, quarter by quarter, how we deliver on that. Where we are very confident is that the sixth consecutive year of a double-digit return on tangible equity will be delivered in 2020, and that translates in sticking to our progressive dividend policy with incremental annual rise. And you know that 1.5 euros per share for 2019 is what the management will target. And with that, I thank you very much for your attention. Looking forward not only to the Q&A sessions, but throughout the day for an interesting dialogue, and hand over to Alexander Habler-Trabek for the risk session.